Hello, this is Dr. Frank Raganese with Pelican Wealth Advisors. We have an exciting topic for you today. It's the perfect investment. We believe that a perfect investment would have the following qualities. First of all, it would have very high contribution limits, tax-deferred growth, stock market-like returns with no stock market losses, therefore we'd have safety of principal, liquidity for withdrawals, tax-free income, especially for retirement, and it would cover all 8 major lifetime risks, such as market risk, tax risk, catastrophic illness, inflation, career, legal, longevity, and death. Let's take a look, first of all, at market risk. Most people are familiar with the meltdown, the dot-com bust from 2000 to 2002, and again we had a 37% correction in 2008 during the credit crisis. So during that 15-year period, the S&P 500 return was only 4.2%. That assumes that a person was invested 100% of the time in the S&P 500, which is unlikely. So their account balance still would have grown from 100,000 to about 186,000. Now let's take a look at tax risk. Everyone's aware of the national debt, which is generally reported at 18 to 19 trillion. However, it's more like $600 trillion if we look at some of our unfunded liabilities. As a result of that, we would feel that going forward, the taxes would probably increase. Since the average tax rate is 58%, it's currently only 39.6%. So which direction do we feel taxes are going to be moving? And we would say the taxes more than likely will go up over the next 20 years to handle our debt. So what does this mean in terms of our perfect investment? Well, we would like growth, income, and protection from our perfect investment. Growth would be essential because we need a competitive rate of return and also a compounded rate of return, because we all know that even Albert Einstein, who called the 8th wonder of the world, was compound interest. Income is also important, particularly during retirement years, so that we can distribute cash without any restrictions. And finally, protection. We would like to make it very important item to safeguard our money from the risk of market volatility and a roller coaster we see on Wall Street. Now, what if we could find an investment that would give you all 3, growth, income, and protection, and at the same time shield your family from all the 8 major risks? Well, we're happy to report at Pelican Wealth Advisors that we are launching a major educational program to introduce a way to potentially protect and grow your money, produce tax-free income, and to protect your family at the same time. Before we get into the details, we first of all want to have a little education on IRS regulations and codes. We all know that 401k, 403b, etc., 529s, these are IRS codes that regulate the taxes on retirement accounts and college savings plans. Do you think the government is a good steward of your money? Yes or no? How about, do you want the IRS as your business partner? I think we'll find that very few people like paying taxes. In fact, our friend, Mr. Dosecki here, his famous saying is, I don't always invest in my 401k or IRA, but when I do, I create a tax time bomb. So what are these? Rule 7702 and 72E. I've asked this question a number of times of clients and friends, and no one has come up with the answer. The reason for that is that it's a relatively unknown IRS tax code that controls the product development of life insurance. Yes, life insurance. But we are not talking about the life insurance that your grandparents had. We're talking about the modern version, which we call Index Universal Life, or IUL for short. I also like to call it investment grade life insurance because it gives us growth and income, and this one also gives us protection. Let me explain to you how this works. For example, the cash value in your life insurance policy is indexed to an index market like the S&P 500 or the Dow. Let's say that the cap is 13%. That's typical of some of the companies that offer this IUL today. In addition to that, there's a floor of 0. So what does that mean? It means if the return on the S&P is above 13, you only get 13. If it's below 13, like minus 10, you don't lose a penny. You have a floor of 0, and your principal is guaranteed. So let's take a look at one other feature of these IULs, and that's called locking in the annual gains. Why is that important? Let's say you had $100,000 and in the first year you gained 10% in the market. That's $110,000. The following year, the market, which is shown in red, drops 10% to $99,000. However, your IUL in green would stay at $110,000 because you don't lose a penny of your cash value. And let's say in the following year it goes up 5%. So now the IUL value would be $115,500, and the stock S&P number on the stock market would be $105,950. That's a difference of about 11%. Now here's an example of the S&P returns for the 15-year period shown, and comparing that with the IUL with a cap of 13%. As you can see, the returns of the negative years, 4.24, yet if we had a IUL with a cap of 13%, during these years where we had returns that are negative, we would get zeros, and then in up years that are greater than 13, we'd have 13. The bottom line is we would get a return of 6.68%, or $271,000. Which one would you prefer? The red, 186, with the roller coaster ride, or the smooth ride of the IUL? So let's take a look even further. Let's go back and look at the 30-year period. And during that 30-year period, which had the 1990s was the go-go internet growth year, you can see the S&P 500 had a return of 9.28. That actually exceeded an IUL with a cap of, say, 12.5, which was only 7.49. Again, this assumes that you would have been in the S&P 500 at 100% of the time, which is unlikely. However, during the last 20-year periods, 15-year periods, and 10-year periods, these you can see the IUL beats, or at least gives comparable results to the S&P 500. Therefore, IULs allow investors to stay in the market 100% of the time without losing sleep and potentially achieve competitive or better returns. Here's an example of how an IUL is funded. In this example, we're talking about a 35-year-old male, and we're assuming that the return is 7% a year. During the first years from 30 to 65, he's funding his contributions at $12,000 a year instead of funding his 401k, or in addition to funding his 401k. And the result is that when he retires at age 65, at this rate of return, although this isn't guaranteed, the historical results indicate that this is possible. He'd have a tax-free income of $119,527. At that time, his cash value would be slightly about over $1.1 million, and he would have a death benefit, which has been growing, as you can see, all the way up to about $1.5 million. This is a graphical representation of what happens. As you can see, the red line is funding the 401k at $18,000 a year, and we're funding the IUL with only $13,500, which is the after tax. We're assuming the tax rate's 25%. He pays the tax on $18,000 and then invests it in the IUL. And what happens? Well, we estimate that when he retires, he'd be able to withdraw, again, at the same rates of return of 7% for both the red line and the green line. His income would be almost $77,000 tax-free. However, the 401k would have to have an income of almost $103,000 at a taxable rate of 25%. Therefore, overfunding a 401k, a SEP, or an IRA creates a tax time bomb, and this particular individual would actually run out of money at 10 years after he retired, which means more than likely he would cut back his spending before that and reduce his lifestyle. Again, Mr. Dosecki says, I don't always invest in my 401k, but basically it's a tax time bomb. Now, there's one more exciting item that I want to point out to you about IULs. Let's say that this particular person has saved $50,000. And we're going to show you how to create your family bank. So you want to buy a car, so you borrow $30,000 from your account. You pay back the loan over 5 years while you're still contributing to your IUL if you're still working. If you're retired, then you don't have to pay it and continue the contributions. The payback of the loan is optional. So the IUL loan continues to earn interest. So let's say 7%. The insurance company will charge you a nominal loan rate of, say, about 5%, which ultimately is deducted from the death benefit. The money taken out of the policy on the loan is working for you in 2 different places at the same time, just like the banks do. In addition to that, the advantage is you recapture the thousands of dollars that otherwise you would have paid to the banks and the lenders. So 5 years later, you have the monies back in the bank and you can buy the car all over again. And again, you have no credit approval process, so it doesn't affect your credit. So let me show you how to create your own family bank. If you are a business owner, it gets even better. You have the potential for some serious tax savings. Call me for those details. So just to summarize, money typically is held in 3 buckets, with the majority of money for most people at retirement age being in IRAs and 401ks, or about 80% tax deferred. What we'd like to show you is a better solution where about 80% of your money is tax-free. What are the advantages of an IUL? There are a number of advantages in addition to no potential stock market gains with no losses, with returns comparable to the S&P, your gains locked in annually, it's approved by the IRS. In fact, if you're under the age of 60, it's even possible to fund your retirement if you become disabled with an IUL. Plus, when you retire, the income from your IUL will not be included in the taxation for the Social Security formula. There are no contribution limits of IRAs and 401ks, so you can put as much money in it within reason as possible. Again, if you're under 59 and a half, you can take a loan without any 10% penalty. And when you reach age 70 and a half, there's no required minimum distribution. You have tax-free income, tax-free death benefit, and the principal is guaranteed by the highly rated insurance companies that we work with. Sounds too good to be true. What's the catch? Well, there are only 2 catches. Number 1, you or a family member must be insurable. Number 2, you must have the discipline and cash flow to fund the IUL. But that's not any different than funding an IUL or an IRA or a 401k. Basically, that's it. Is an IUL right for you? You want to discover a little-known strategy? It is. If you want to discover a little-known strategy that allows you a competitive rate of return in a tax-favored environment without any stock market risk. Or do you have children or grandchildren who would benefit from an IUL for tax-free planning, legacy, or college funding? If you are, give me a call today at 239-287-3146 to find out if an IUL is right for you or a member of your family. And finally, a disclaimer, our company does not provide tax or legal advice. We recommend you consult with a professional in each of these areas. The examples shown are for illustrative purposes only and are not a guarantee of performance. The safety of principal and income from an indexed universal life policy is subject to the claims paying ability of the insurance company. Thank you for listening.